Hey everyone, recently there was an IPO of an IT company, Orient Technologies, and I received a lot of requests to discuss it. Company's market cap during IPO was around 850 crore at an upper price band of 206 rupee. So it's a micro cap company and its IPO received a stellar response that got oversubscribed by 155 times. What a crazy time we are living in, IPO getting oversubscribed by 100-200 times. Although majority of retail investors only invest to make quick money from the IPO. And their filtration criteria is also very simple, grey market premium. So if a company fetches high grey market premium, it gets crazy response. And as expected, because of stellar response, Orient Technology got listed at 302 rupee versus the IPO price of 206, reflecting 47% jump on listing day itself. The reason I did not discuss it before the IPO is because I knew that it would fetch a crazy response and probability of IPO allocation would be very low. Plus those who would get the IPO, it would be one lot in general, so it won't change your life. That's where the key question is, now that Orient Technology is listed and you can invest a higher amount, is it really worth investing in the company at current valuation? Because even after such high gains, company command a PE of 32. So is it worth paying this PE to the company? Can there be more scope for PE expansion? Now, before we directly jump on to the conclusion, it's very important to understand the business model of the company, because I'm sure majority of retail investors would not have any proper idea on Orient Technology business model. The catch is that in IT sector, just names like your cloud, artificial intelligence, machine learning, advanced analytics are enough to create buzz. And of late, there's a lot of buzz around data center as well. But many people fail to understand the real business of IT company. Trust me, it's not that easy. You need to deep dive into the documents and also need a decent experience in the sector to get a fair understanding of the business. If you don't have a proper knowledge and if you end up investing at higher valuation, IT companies can also destroy wealth. Those of you following this channel would know that I have an IT background. I was an ex-data analytics consultant, so I have a fair idea of IT business model, and that is what I have tried to share in this video as well. I still remember the IPO of Happiest Mind in 2020 when the IT sector was on boom. Happiest Mind IPO was at 167 rupee and within a year stock touched levels of 1500. Unfortunately, a lot of retail investors ended up buying Happiest Mind at very high levels, and it's been more than 3 years since the stock is down 40%. So the point is, it's not just about the fundamentals but also about the valuation, because at the peak, Happiest Mind PE was 144, which was certainly not sustainable. So in this video, I'll help you understand the business model of Orient Technology so that you can get a fair picture about the company. And then we'll look at the financials, future potential and valuation part. But before we discuss further, the idea behind this video is purely to share my knowledge with you all. It's not a buy or sell call. If you're looking for buy sell call, unfortunately, this is not the right channel. But if you're a knowledge seeker, I'm sure my videos would be very helpful. And in case you are a long-term investor looking for close association with me, you can explore my weekly video series that include one exclusive video where I discuss my own investment strategies. I've recently shared my latest portfolio that include my top conviction bets and thought process behind building the portfolio. But it is strictly for long-term investors and more for knowledge purpose, not to give buy-sell call. My intention is to empower you all with right knowledge so that you can take your own investment decision. I've shared the link for the weekly series in the pinned comment. Alright, let's get started with Orient Technologies business model. So Orient Technologies was established in 1997 as an IT solution provider. Its offerings are divided into three key verticals. First is IT infrastructure. Within this segment, company offers data center solutions like server, then networking components like routers, switches, then cybersecurity solutions like firewall, antivirus, as well as hyper-converged infrastructure that integrate your server, storage and network component and provide backup and disaster recovery software. Please note that Orient Technology is not the manufacturer of these IT products like servers, networking component. It collaborates with companies like Dell, Nutanix for the products and services. IT infra is the largest revenue generating segment of the company with 52% contribution in FY24 revenue. But this is a commoditized business. Today, there are hundreds of IT companies in India that offer IT infrastructure solutions. This segment has a margin of just around 8 to 12%. Now, this is one piece of information I could not find on any document. But this is the most important information that tells whether company has a sustainable moat or not. That's where I watched the management interviews to understand the margin breakup of various verticals. So this is a low margin business that clearly says that it is a commoditized work with extreme competition. It sounds very fancy to hear words like data center, and there's certainly a huge potential in data center. But you should ask, what is the work that company does in the data center value chain? Because the most important aspect of data center is data processing. And for that, you need GPUs, that is graphic cards. But Indian companies don't manufacture these graphic cards. The leader in this space is NVIDIA. Likewise, there are various important components used in data center, but Indian companies hardly manufacture these components. They are mainly involved in the solution part of the data center, which is more of a commoditized work. And remember that the market always gives a valuation to the company based on its competitive strength and sustainability of the business. So you can't expect an IT infrastructure company with commoditized work to command a premium valuation with PE of say 60, 70 or beyond. Yes, in the short term, if there is a boom in IT sector, then even IT infrastructure companies can command a high PE ratio due to bullish sentiments, but they won't be sustainable. That's why it's important to understand what you are buying, and more important is to know what price you are buying. Now moving on, company's second vertical is ITES, that is IT enabled services. It basically includes managed services that involve your monitoring, maintenance and support of IT system and your backup and disaster recovery services. It also involves hardware and software support through various AMC and including your troubleshooting, repair and maintenance service for devices. Basically a back-end IT work for any organization. In FY24, ITES contributed 22% in company's revenue. Although it's a higher margin business with 25 to 30% range. But this is again a commoditized business where there are hundreds of IT companies in India providing these ITES services. Then within this segment, interesting work is that company has also forayed into device as a service, which is DaaS, where they provide your desktop, laptop, then tablet, printer, scanner, smartphone and servers bundled with software along with managed service on a pay-per-use model, which is a subscription basis. So this is an interesting space to watch out for. And then third vertical of the company is cloud and data management services. Now this is an interesting business vertical that uses new tech solution like your cloud deployment, which is migration of data from on-premise to cloud, along with services like data analytics, business analytics, then RPA, that is robotic process automation. In simple words, RPA is a process to automate back office functions such as extracting file, filling forms, then file transfer, etc. This segment has a good margin of 15 to 20% and currently operates, contribute around 26% in company's overall business. Now, one thing I failed to understand is, on one side, Orient Technology has around 52% business from IT infrastructure, which is 8 to 10% margin, and 48% business from IT enabled service and cloud and data management, which is more of 15 to 30% margin range. Then ideally, company should have at least 15 to 16% kind of blended margin, isn't it? But their overall margin in FY24 is just around 9 to 10%. And this is same for last 2-3 years of data that we have. So clearly their majority of business at the moment is commoditized with lower margin and higher competition. Although one good thing is, in FY22, 70% of business was from IT infra side, and that is now reduced to 52%. Cloud and data management, which is more of new age IT work, was just 12% in 2022, which is now 26%. So going forward, it would be interesting to see the business mix of the company and growth of the third segment, which is cloud and data management. But today, Orient Tech majorly has a commoditized business, and that is clearly visible from their margins. Another important aspect of the business is revenue contribution by geography. So unlike the traditional IT business, which is export oriented, Orient Technology has 99% revenue coming from Indian market. So it mainly operates in the Indian market. It also has around 15% business coming from Indian government. Now if you look at company's leadership, Mr. Ajay Sawant, Jayesh Shah, then Ujjwal Matre and Umesh Shah are the co-founder and promoter of the company. Mr. Ajay Sawant is the chairman and MD of the company, and rest are whole-time directors. He completed his Bachelor of Engineering in Electronics from Ram Rao Adik College of Engineering, University of Bombay in 1988. He has more than 25 years of experience in IT industry, but I did not find anything exciting in promoter's background. Next very important aspect is to understand the future growth. Friends, as far as future is concerned, I always say that future is digital. But you should ask, what are the sunrise technologies in digital sector that have bright future. And that's where technologies like artificial intelligence, machine learning, cloud computing, big data analytics are growing at much faster rate. So companies that would work on these sunrise sectors would grow big time. Unfortunately, majority of companies with core competencies in this sunrise sector are not from India. They are the likes of Amazon, Microsoft, Apple, Google, Nvidia that rules the future technologies of the world. India is more of an IT service provider that has the biggest strength of providing low-cost IT services. So for instance, if Microsoft offer Azure cloud solution, you need IT companies to deploy these solutions at large scale. And that also require a very good skill set. And that's where IT companies add value at lower cost. Plus, since North America is a key market of IT sector, IT companies earn in dollar and majority of expenses are in rupee. So that model has worked out very well. But today there are hundreds of IT companies in India. So it's a highly competitive space. And it's very important to understand the business model of the company before investing, so that you get a clear idea of company's moat and its future potential. Now coming to Orient Technology specifically, there's certainly a high demand for IT enabled services. And as more and more companies would adopt technology in India, this segment would continue to grow. But the growth of this segment is not exponential. In the past, this industry has grown at around 6 to 8% and would continue to grow at a similar rate. However, the bigger opportunity is in the new age technologies like cloud deployment, data analytics, robotic process automation that are growing at much faster rate of 20-25%. Plus, they also command a better margin profile. Then data center has immense growth potential in India, mainly because India is generating humongous amount of data and that data needs to be stored for processing and analytics, because data is the new oil of 21st century. Now today a major chunk of that data is stored outside the country, and even Indian government wants that data to be stored within the country. On top of this, with rise of startups and digital ecosystem in India, there is going to be massive need for data centers within the country. So that is a great opportunity for IT infrastructure companies to benefit from this trend. But going forward, everything will boil down to Orient Technology's ability to benefit from this trend like data center. More importantly, it would be crucial to see how it moves from commoditized and highly competitive low margin IT infra business to a higher margin new age tech business of cloud and data management. Now let us look at the key risk in company's growth thesis. So first key risk is extreme competition. As discussed, the biggest risk for the company is extremely competitive market. Majority of their work is commoditized and there are hundreds of IT companies in India doing similar work. So this competition risk would always exist. Second risk is client concentration risk. Company's top 10 customer contribute around 38% in the overall business. So any loss of business from top 10 customer can have significant impact on company's top line and bottom line growth. Then third risk is attrition risk. In IT sector, talent attrition is one of the biggest risks, and Orient Tech has quite high attrition rate. In FY22, it was 45.48%, in FY23 it fell down to 31%, and FY24 it is 21.8%. Now this has been a trend of fall in attrition in overall IT industry, but if you look at the average attrition rate in IT industry, which is around 12 to 15% in FY24. So obviously this company Orient Tech has higher attrition rate as compared to the industry average. Also I checked the Glassdoor rating for the company, which is 3.4, which is again lower than the average rating for IT company. Then fourth risk for the company is high trade receivable. Company has a credit of sale between 60 to 120 days. Hence it has high level of outstanding trade receivable. In FY24, it is showing 158 crore of trade receivable. As a result, company's cash from operation is on the lower side. So any delay or default in payment and receivable can impact company's cash flow and profits. And then fifth risk is technology obsolescence risk. As an IT company, Orient Tech future performance would mainly depend upon its ability to innovate and offer new age tech solution. Any failure to innovate can pose significant risk to the company. I hope you got a fair idea of risk in the company's business. Now let us look at the final part of this video, that is financials and valuation. Since it's a recently listed company, we don't have a lot of historical data. But if you look at last 3 years of P&L, revenue was 467 crore in 2022, that has increased to 603 crore in 2024. We are ignoring 2021 as it was COVID period. Company has an average margin of 9 to 10%. Its operating profit was 46 crore in 2022, that has grown to 57 crore in 2024. And net profit is up from 33 crore to 41 crore. So the top line and bottom line growth in last 2 years is very average at 12 to 15%. And remember that company's ability to command a premium valuation largely depend upon the growth rate. Although other ratios are good, with ROE of 27%, ROCE of 34%, debt to equity of 0.06, which is negligible. But cash conversion is on the lower side. So going forward, it's important to keep an eye on the growth rate. As of today, company has an order book of around 100 crore for the next 2-3 months. So there's not much visibility in terms of order book. Finally, on valuation, Orient Technology launched its IPO at 206 rupee, which is a PE of 20. Now, considering the nature of their work, which is mainly commoditized, it was a fair valuation. And now, after 50% jump in share price, P ratio is 32. In my opinion, this is already a premium valuation. You can't expect this company to trade at 60-70 PE because of its commoditized business offering and 12 to 15% growth rate in the last 2 years. So I don't see a lot of valuation comfort after 50% jump on IPO price. In my opinion, considering the nature of their business and earning growth in the past, the fair valuation of the company should be in the range of 20 to 30 PE. But if the share price jumps from current levels in the near term to say levels of 400-500 rupee, it would become very expensive. And remember that if there are strong positive sentiment, stock can actually jump multiple times. We have seen that crazy growth of IT stocks during COVID bull rally. So that can happen now also as we are in a bull rally. But if you end up buying at higher levels, it can even destroy wealth. So in this video, we discussed the business model of Orient Technologies. These days, every other IPO is on hype and getting listed at premium valuation. So it's very important to understand if it is worth investing after the IPO or should you wait for correction. Overall, it's just another IT solution provider with mostly commoditized work. Yes, their third business offering of cloud and data analytics is exciting and has higher margin, but it is a small part of their business as of today. So going forward, everything will boil down to companies focus on new age technology solution and how it leverages the demand in emerging sector like data center. If company can expand its margin in the future and able to grow at faster rate, it can see valuation re-rating. But for now, current PE of 32 is already a good premium to its fair valuation. But this is my personal opinion, I might be wrong. The idea is to just share my knowledge with you all. I hope you'll find it useful. Now tell me, what do you think about Orient Technology? Is it worth investing at current levels or not? I'll see you next video. Till then, take care.